Welcome back to Pro News. As geopolitics is still the main play in town, there has been a lot in the markets lately. In the US, the macroeconomic landscape keeps everyone on their toes. Some sectors are thriving while others wobble, leaving the Fed with a challenging monetary policy decision. Retail sales in September saw a 0.7% increase following a 0.8% rise in August. This was almost 3 times more than what was expected. This uptick is backed by job growth and increasing incomes. However, it's not just about more jobs and better wages. It also reflects how people are reacting to steeper prices and consumer credit costs. Yet, here's the catch. Instead of curbing inflation, this trend is likely adding fuel to the fire. Moreover, US industrial output and capacity utilization are on an upward trajectory, signaling strength for the dollar. Why? It indicates that the prevailing interest rates aren't stifling economic growth, pushing the needle in favor of potential rate hikes. At the very least, current rates might remain stable for an extended period. This scenario bodes well for the dollar, elevating the allure of dollar bonds on the global stage. Geopolitical dynamics are also boosting the dollar's appeal as a refuge, distancing it from global upheavals and riding the wave of increased demand for US products. US existing home sales fell below 4 million. During the COVID pandemic, the sales were higher, and only in the darkest times for the US economy during the global financial crisis, we saw lower levels. It's all the fault of 8% mortgage rates. Yet here's a twist. Despite all the dramatic movements, the dollar index has slightly dipped for the week. 14 consecutive weeks of growth is a tough act to maintain, especially when many are eager to cash in on their gains. Gold is reacting to Middle East events, rising consistently. Recently, gold peaked at $1,980 an ounce, the highest since July. Despite challenges, geopolitical factors are pushing gold up. One major challenge is the appeal of US government bonds, especially with 10-year treasuries nearing a 5% annual yield. This is the market's highest offer in over 15 years. Such bond allure led to gold's drop in September, but it's overlooked now. Currently, gold is nearing an overbought state, making it susceptible to shifts due to factors like high bond yields and a stronger dollar. Also, the ongoing Middle East situation isn't a solid long-term boost for gold, as chaos doesn't typically support prolonged demand. The US stock market went under pressure last week. Increasing bond yields are making stocks less appealing. For the first time in over 2 decades, S&P 500 returns have dipped below bond yields. With stocks posing greater market risks, there's a noticeable shift of investments from stocks to bonds. In this scenario, purchasing declining stocks isn't as tempting when bonds offer similar returns. Technically, the Nasdaq 100 is showing a bearish trend within a broad range. Its recent push to the upper boundary triggered more sales. The 50-day moving average has also been a consistent sell signal. The index hasn't shown positive momentum above this average for the past 2 months. Now the index is nearing its monthly low of 14,500. The big question: will it rebound or will the decline intensify? We're leaning towards the latter. Oil has rebounded since its early month dip. WTI oil is nearing $89 a barrel, while Brent surpassed $92. Unlike the past, when global unity led to significant oil embargoes, recent calls by Iran for bans haven't gained much traction within OPEC. This has contributed to a subdued rally in oil prices. US oil production is surging, transitioning from a primary import to a leading export within a decade. The recent easing of US sanctions on Venezuela, letting it sell its oil, further curbs oil price jumps. Plus, major players like Russia and Saudi Arabia aren't showing intent to cut sales, while countries like China and India are keen on purchasing oil from nations under US sanctions. Technically, oil prices exhibit growth potential. The early month sell-off put oil in an oversold state, but recent rallies have stabilized prices. Positive US data suggests healthy fuel demand, and China's economic metrics indicate renewed growth. It wouldn't be unexpected to see oil prices touching last month's peaks, surpassing $92 for WTI and $94 for Brent. Bitcoin had a roller coaster week. Due to incorrect news about a Bitcoin ETF, its price jumped close to 30,000 a coin. When the mistake was cleared up, the price didn't drop all the way back down. By Friday, it reached 29,300. After a dip since August, Bitcoin has bounced back. During times of global unrest, Bitcoin seems to be a choice for shifting money around. Not exactly a safe spot, but more of a sneaky channel. Charts show a bullish trend for Bitcoin. It's consistently above some key averages, hinting at more growth. Some think next week Bitcoin might push for the $31,000 mark. Last time in July, it didn't hold there. Will this time be different? On another note, other cryptocurrencies or altcoins have been a bit shaky this week. When big players focus on Bitcoin, others often lag behind. But will this rally boost interest in altcoins? Let's wait and see. Here's what's coming up next week. Currency and stock traders, keep an eye out on Tuesday. The Eurozone PMI data is dropping during Europe's trading hours. Wednesday's focus? The Bank of Canada's interest rate decision. Then on Thursday, it's the European Central Bank's turn. Most expect rates to stay the same, but with Canada's rising inflation, a hike isn't out of the question. If that happens, the Canadian dollar might get a boost. Friday is packed with US data. We've got personal income stats, consumer feelings, and some inflation numbers from the University of Michigan. Trade smart and catch us next week for another market roundup.